Hey guys, it's Andrew from Dividend Growth Masters. Today I want to talk about a really interesting strategy where you can generate passive income on stocks that you already want to own. Now, the strategy involves selling put options. In fact, it's called the cash secured put option strategy. So, if you don't already know, a put option is basically a contract where the buyer is allowed to sell a stock, an underlying stock, at a predetermined price to somebody based on an expiration date. So, instead of actually buying a put option, we're going to sell one. So we're going to take the opposite end of the transaction. And so what that means is we have the obligation to purchase the underlying stock at a certain price at a certain future expiration date. So basically, if we take the other end of the transaction, if we are short, as you would call it, short a put option, then we're basically like writing an insurance contract. So we're betting that the stock will not go to past a certain level. Now, when you sell a put option, what you are doing is you're gaining a premium because the buyer is paying you for the contract. So it's kind of like insurance. So like a buyer of car insurance will pay the insurance company in case something happens to their car or their house. So this is basically the same situation here. Instead of the insurance company, it's going to be us on the other side of the transaction. And why this strategy is great is because it allows you to generate passive income right off the bat when you sell a put option. So let's take the S&P 500, for example, the SPY ETF Trust. So it's trading at $396.03 right now. So let's take a look at the options chain. Say we sell a put option at basically where the stock is trading now. So it's at the money, 396. So if we sell the options contract, we're going to generate $403, basically about $403 of income right off the bat. Now, basically, what we're saying is if the stock stays flat, basically, or if it goes up, we're going to the buyer is not going to exercise the option because the stock is trading higher than the put option price that they purchased. So if they bought the $396 put option strike price and the stock goes to say $400 per share, there's no way that they're going to exercise it because they could make more money selling it on the open market at $400 per share versus selling it to you under the put option for $396. But if the stock goes down, if the S&P 500 goes down and it goes down to say 395, then in that case, the option will likely be exercised. And when that happens, you will be assigned the stock. So remember, an options contract is for 100 shares. So if you sell one contract, you have the obligation to purchase 100 shares. So let's say we sold the 396 strike put. So if it gets exercised, we need to buy 100 of them. So that would basically be $39,600 if the option is exercised. So under the cash secured put strategy, what you're basically doing is having enough cash to purchase those shares if you are assigned those shares. Now, what makes this strategy so great, especially right now, particularly in a bear market, is you can sell options, you can sell put options on stocks that you really want to buy and that you really want to own and generate a premium. So let's look at the entire chain here for all of the strikes. So let's say we're very comfortable buying the S&P 500 at $385 per share. So in that case, we would look at the $385 strike put, and then we would sell that one. So in this case, the $385 strike put is trading at about $85, $86 per contract. So the strategy basically involves selling this contract and waiting and see what happens with the underlying stock. If the underlying stock, which is trading at 396, let's say next week it drops to 389. At that price range, the options will not be exercised because it hasn't reached the strike yet. So you're gonna keep the premium no matter what. If you get assigned the shares, you'll buy them, but the premium is yours to keep. Let's say the stock rallies next week, the S&P 500 rallies, and it goes to say 400. In that case, the option will not be exercised. You won't be assigned the shares, and you'll just generate the $86 in premium. So as you can see, it's a great strategy for generating passive income on stocks that you already want to own. Now, one thing to keep in mind with the cash secured put strategy is that you do need to have enough cash to buy the shares in case they are called. That's why it's called cash secured. Another thing to consider is that if the stock falls below the exercise price, you'll be obligated to purchase it. So let's say we sold the 385 strike put and the stock falls to $380. The option will be exercised, so we'll have to buy the shares from the option buyer at $385, even though the stock is trading $5 lower at $380 per share. So basically, in that case, we lost $500 minus the premium that we earned. So that is one of the risks that comes when you're selling put options. Okay, so we talked about a little bit about the strategies. So let's talk about how to actually implement it. Should you go after ETFs? Should you go after individual stocks? And so on and so forth. In general, writing cash secured puts on the S&P 500 or an index is a little bit less risky than individual stocks because they're less volatile. But obviously, the returns are lower because the volatility is much lower. And one of the biggest inputs on an option price is the volatility. So the great thing about the cash secured put strategy is basically you can set the exercise price of the options at whatever you want, whatever you're feeling comfortable with. So let's look at another stock in particular. Let's say Amazon. So let's say you always wanted to own Amazon stock, but you just never gotten around to purchase it for whatever reason. So Amazon is trading at $94.14 right now. So let's say you're comfortable buying Amazon shares at say $85 or $80. In that case, what you can do is basically sell the put options and generate passive income while you wait for them to be exercised at some point. Let's look at the December 2 one. So that's 14 days from now. So in the example, let's say we're willing to purchase Amazon shares at $85 per share. So for the December 2 put options, we can generate about $52 per share. $52 in option premium by selling the 85 strike puts. Now, the great thing about this is if Amazon is a stock that you already own, then you really don't care if the stock falls and you are assigned those shares, and then you have to purchase 100 shares at $85 or spend $8,500 to invest in Amazon shares. because it's a stock that, again, you already wanted to own. That's why this strategy is so great, because you're generating income every single week, or however long you write the options for. So you're generating income on that while you're waiting for the Amazon stock price to basically reach a level that you're comfortable purchasing the stock at. Let's say Amazon stock rallies and you never get to that level that um, where the options would be exercised and you would be assigned the 100 shares. In that case, you're still generating the cash flow every single week when you're selling these contracts. So right now, the strategy I'm implementing personally with the cash secured put is basically on tech stocks, especially since the environment is so volatile right now. The premiums on the put options are very, very high, which means you can generate a decent return. I would say between 1.5% and 3% a month is definitely achievable right now, and on an annualized basis, that's obviously double digit return. So it's a pretty good return. So right now, I'm primarily focused on the cash secured put strategy for Amazon, Apple, and Google. So those are the three primary stocks that I want to own, and I'm just writing cash secured puts on them. So if they ever reach the level that I'm comfortable paying for, great. But if not, I'm still going to be earning the premium every single week from selling these put options, no matter what. So the cash secured put is a really great strategy to not only generate passive income every single week, but it's also great because it allows you to purchase shares on companies that you already want to earn, or that you already want to own at a price you're comfortable with.